Welcome to the Broken Pie Chart Podcast, episode 307. I'm your host, Derek Moore, and with me is a guest host back on the program. I think it's the fifth time. You're kind of the Tony Randall of guest host. Remember Tony Randall? Spencer Wright from Halbert Wealth. Spencer, what's going on today?
Hey, Derek. I'm really glad to be here. Looking at the aftermath of another red day in the markets.
Yeah, I'll mention to the audience, Jay, as I said, he'll be off through the end of January. Hopefully he'll be back in, our plan is in February. But Spencer, what did you do today? Was employment too good? It's too good. Okay.
Employment was really good. And I think surprisingly good. And it may be hard for people to understand, but that's a problem.
Okay, it's a problem because people are saying it wasn't bad enough, meaning, and just for the audience, the unemployment rate came in rounded 4.01 for the exact folks in the audience, 4.086, and I still rounded. And civilian labor force grew, employed grew, unemployed went down. The unemployment went from 4.2 to 4.1. But Spencer, that means the Fed isn't going to cut it, isn't it?
That's exactly what that means, which is why the 2-year yield continues to rise.
But wait a second. I mean, is the market? I mean, okay, I get it. That's one of the excuses. But would you rather employment was really bad, so things are really bad, so the Fed can lower? No, you don't want that. And we're at one of these phases. Sometimes the market does this where good news is bad and bad news is good, and we find ourselves through the looking glass right now, and eventually things will straighten themselves out. But right now, the fact that it was good news that the employment number was stronger than anticipated was bad news for Wall Street. Jay and I always say, do we want to scare the audience? Do we want to be very overly bullish? And sometimes we get people complaining we're overly bullish. I want to give both cases to it today. Mm-hmm. But I don't know about you, Spencer, but I looked at the Fed funds futures tell us something about where the market thinks rates are going to be in the future.
Sure.
Last week, I looked and I said, let's just not bear the headline. I mean, you look at the rate cut situation, it's basically one rate cut. And is that by September? I know, October, right?
By October.
But it's one. It's one this year.
Yeah, one. Yeah. The pricing in one cut around October, and that is a radical departure from where we were just a month ago.
Now, high rates aren't necessarily bad. We saw that in the mid 90s,
right?
But it's the readjustment. It's how you get to that, whatever the equilibrium or the natural rate of interest is, right?
Well, that's right. I mean, consider that the 50-year mean is around 4%. And for a long time, we were way below that, as we can all remember. And now we are slightly above that, even after some Fed rate cutting. Point being is where we are interest rate-wise, historically, is not a big deal.
Well, it's a big deal if you thought the 10-year was going to go down, and it didn't. It went from 3.2 to 4.2, and now it's 4.75 as of today.
Right. And the higher the 10-year goes, it becomes problematic for Wall Street, particularly for the Nasdaq.
Well, the Nasdaq is, I mean, you would say, yeah, I would agree. Like you think about your companies, and I think where you're going with this is you have to discount down the future growth, and that's the growthiest thing, right? So that's where you're going with that.
Mm-hmm. Yeah, you once all that's baked in, that does not. If that is the case, if that is where the market is right now, that would imply that there's going to be more downside.
can I take the bull case though?
Mm-hmm.
The bull case is it's tied to the nominal rate of the nominal GDP growth rate, and we haven't had a nominal GDP growth rate that's been consistently above 5 in quite some time. So
True.
the bull case is we probably maybe, and when I look on some technical basis, I could make the argument we go to 5-6 in the 10-year, and it's because of growth. I mean, that's the bull case right now. This is a growth story, not inflation is really coming back and that's why it's coming up.
Right. And that could very well be. And if that is the case, there's still going to have to be a period where the markets catch up to that and where that is actually embraced as the environment that we're in. There's not enough evidence right now to fully support that, which is why we've seen a lot of chop over the last 6 months. I mean, sticking with the Nasdaq, as represented by the ETF QQQ, you can look at it and say, well, over the last 6 months, tech stocks are only up, or rather are down about 3% over that period of time. So basically, they've gone not much of anywhere, and that's linked directly. I mean, you can chart these things. It's linked directly to the 10-year continuing to rise.
I mean, we're at a price level we haven't. This is funny me saying this, but we're at a price level we haven't seen since all the way back in just after Thanksgiving, November 29th-ish, right? If I'm looking at the chart, right?
That's correct.
So, yeah, I mean, we did sort of a round turn, and you're right. From over a month ago, we're right back where we were,
and we're very close to the high back in July, about July 10th. Mm-hmm. We hit a high on QQQ of around 500, 501, and then the market just split wide open. And people, memories are short, but there was a sizable drawdown, through for about a month throughout the first week of August.
Yeah. I'm looking at that level, and you're right. So it rallies up. I mean, it really started at the end of April. The Nasdaq rallies up, hits the high in, I think it's July 10th, right? You just told me that. So yeah, July 10th, comes back down, makes a bottom, makes a higher low,
right?
And then it just sort of rockets up. But yeah, I mean, look, you could. Here's the thing. I mean, the audience knows that's why we're big proponents of buying and hedging. And look, if you want to, Spencer and I'll speak for Spencer for a second. We're not telling you to buy or sell. We're not telling you to sell the market. We're not telling you to buy the market. If you want to sell it, you sell it. If you want to buy it, you buy it. That's why we buy and we hedge. But on a technical basis, it is interesting that I don't think it's breached any really bad technical levels yet. But
not yet. But
you got to see if it holds support here.
Right. The 500 level, is sticking with the QQQ, 500 needs to hold. Big round numbers are always good, but it also happens to be right in line with the high back in July.
Yeah.
And there are a couple of reasons. If 500 doesn't hold, right now, the QQQ index, however you want to look at it, has formed, if I can get a little into the weeds here, has formed a triangle pattern, a classic triangle pattern. And triangle, patterns are usually either perceived as being bullish or being bearish, and triangle patterns are neutral, and they can resolve either in a bullish manner or in a bearish manner. And if the NDX / QQQ trades below that 500 level substantially, if it pierces it, that would mean that triangle has resolved to the downside, and we could be in for a drop of who knows, but some magnitude.
Yeah, I mean, it's possible. It's always possible that we see some. I want to ask you a question too. I mean, just keeping with rates. You know how sometimes, and you and I have talked about this offline. stuff matters when it matters. And for the audience knows, I always say, well, Greece's debt to GDP mattered back in 2014 or whenever that was, and now it doesn't
Right.
matter even though it's higher.
Right.
Have you seen the gilt yield? So the UK bond, the 10-year bonds, they are
Yeah.
higher than they were when the government had to come in and be a backstop.
Right.
Apparently, it's not as big of a deal now because maybe there's not some implied leverage or whatever it is. But I know you watch this stuff. That's interesting to me.
It is, and again, and that's always that's a great phrase that I heard you use first years ago, and I've used that with other people over the years. Things only matter when they matter. Right now, the level of the 10-year matters. It matters a lot. But eventually, if we keep getting corporate earnings that are robust, and I think we will, and regulation, perhaps going forward here in the next 6 months or so, we start seeing signs that regulation is going to begin easing across a number of fronts. A lot of those things will start stacking up to a growth case, which will support the 10-year being in the range that it's in, the Fed standing pat, and then markets can advance on a growth basis that the country is really pointed in the right direction. Things are being set up for long-term growth trajectories, and that's far more sustainable than waiting on what the Fed is going to do next and how it's going to impact interest rates, inflation, and borrowing to subsidize the operation of classically leveraged technology firms.
I think you're right. I mean, it right now the Fed matters, and what the Fed matters, and every time one of these Fed governors speaks, the market moves on it. The Fed funds future matter, but once they get to a point where we've either lowered as much as we're going to lower, or we're not doing anything more, then other things start to matter. I will ask you though. I mean, to me, it's not healthy that we didn't have. You have the 3-month treasury or the front end of the curve, and we were inverted. Of course, we're uninverted now. We're back at a normal curve. But the idea that you're going to give your money to somebody for 3 months and get more of a return than you would giving it for 30 years is not right. Like you're taking up your money and you're agreeing to a long-term deal. It's like, think about a sports team who has to sign a player for 1 year for $30 million. Go sign that same player 10 years for $30 million a year and you're locked up. Like, this is good. You want it. You should get more interest, more of a coupon going out in the curve.
You should.
I mean, I think it's not that bad, the fact that the long end rates are going up.
No, the long end rates need to rise. Okay, and we are seeing that, and they will continue to rise so long as the Fed stands pat on rates. This higher for longer. Powell said originally, and people kind of forget this, but I just, you and I are not normal. Powell said originally, that he wanted to return rates. The Fed would return rates to a long-term run rate of 3%. Now, that is accommodative by, as I mentioned before, by historical averages. That's accommodative. But inflation is remaining stubborn, and they're committed to the 2% number. And we may get there at current interest rate levels, but we may not get there until much later in the year, closer to the end of the year. And that doesn't mean that there won't be growth. There are a lot of ways to generate growth and that are robust for markets. What I would like to see happen is that we get away from being. I don't want the Fed to matter so much anymore. I want the larger data to matter. I want earnings to matter. I want the things that traditionally propel markets forward to matter, and not the next word coming out of Jerome Powell's mouth.
All right, let's talk about. Let's see. Do we want to be bearish or bullish here? Let's stay bearish for a second.
Okay.
The dollar index. I know you follow this.
Mm-hmm.
I follow both the we call it the Dixie, the DXY, which is the dollar index, the one you hear about the most. It's very Eurocentric. I like to follow the trade weighted U.S. dollar index.
Mm-hmm.
That one, as you know, and I just did a 5-year chart that I looked at. It's broken out to new highs. Why is
Correct.
the problem? And I'll just kind of think broadly about the problem and get your thoughts. If the dollar is too high, all of the multinationals, which by the way are a lot of the big companies in the S&P 500,
Mm-hmm.
their foreign earnings that they repatriate back, and all of them, they're U.S. companies, they report in U.S. dollars. The value of the foreign earnings is less when you convert it back to U.S. dollars. That's
Correct.
why in 2022, you had Microsoft, for example, would do an earnings call, and then there'd be a little footnote in their release, and it would say, the dollar adjusted earnings would have been this, but because of the dollar was too high and the currency exchange, we lost a little bit of the EPS. To me, I know the 10-year is important, but rates and currencies are a relative game, meaning the dollar is against another country's currency. And right now, the fact that our rates are rising the way they are, it's causing the dollar to rise. So,
Right.
all right, Spencer, is this, if we want to be bearish, and I'll take the bull case on this too. I'll
Mm-hmm.
do that in a second. But
Mm-hmm.
I mean, this could be an issue.
It could be. When you consider that the number of companies that drive the growth of
Yes.
these indices are very narrow. We're talking maybe of a dozen firms, and if we rattled off the names, you'd know all of them. They're gigantic multinational entities, and they earn money all over the world. And the dollar going higher literally costs them money. It eats into their returns, and it becomes problematic. Now, they also, the reason this is largely problematic, they may choose not to repatriate those funds. And
Talk about that a little bit.
Well, you have companies like, let's just take Apple. I think is very historically has been sort of the example of this. They keep a lot of the funds overseas. They set up these large entities. This is all legal, by the way, but they set up these large entities, usually in Ireland. There's some other places, but Ireland's been the one I think Apple has used, and other large multinationals, where all the foreign earnings, all their ex-U.S. earnings get funneled to this entity in Ireland, where they sit, and they don't pay. They don't pay taxes on those monies until they bring them back. They pay taxes overseas, but the taxes overseas are less than repatriating the money and losing to the exchange rate in the bargain. And we're talking about billions, tens and hundreds of billions of dollars. So the exchange rate matters. And it can make the difference between having a good quarter or a bad quarter, or a good quarter or a real good quarter. And, those things matter on Wall Street. And that's why a lot of these companies will sit on money outside the United States on the order. We're talking tens and hundreds of billions of dollars that they could repatriate and put to work here, but they won't, because they'll lose money on the exchange rate. And they're paying less right now, at least, in gains on those dollars overseas.
Okay, I'm gonna take a counterpoint. I'll take the bull case on this. Although I agree. I mean, a stronger U.S. dollar is usually it negatively affects earnings. We haven't seen it yet in the earnings expectations. Okay, here's the contrarian point. If I have to make it, China, their 10-year rate is likely to, if it's not at 1 already, it's heading that way, or maybe south of there. I think some of the shorter term rates have they're under 5s. I think are getting close. The Chinese yuan is losing value relative to the U.S. dollar. So if you think about input cost, if you are having to manufacture overseas, or you're having suppliers that are you're paying and you're converting your US dollars to other currencies, maybe emerging market currencies, the US dollar has a lot of purchasing power right now. And I'm look, I agree. It's because we see it. We saw it in 2022. Every earnings call, they started to say, well, but for the dollar headwinds. But if I wanted to take the contrarian case, I would say, well, maybe your input costs get a little bit cheaper. And if we see tariffs, and they could be for a little bit, they could be threatened but never implemented. If the input costs are less, maybe that offsets the tariff effect. I don't know. I said, look, I want to try and get both sides of it, but I tend to agree. I mean, the dollar doesn't matter till it matters, and there's sort of a range of insignificance. We might be getting to the range of significance here.
Well,
I mean, do you buy it all, Spencer? I mean,
I do. Dollar? I do, and I think having it's fine for the dollar to be strong when regulations are on the wane. Unnecessary, burdensome regulations are being offloaded, being reduced, being eliminated at home, and you have a lot of growth being generated here. When there's larger energy production, there are having a stronger dollar then is not necessarily an issue. Having a higher 10-year yield is not necessarily an issue. The trouble is that we are not in that space yet. And that is an unknown, even though one could argue that Trump is going to be good for the markets in certain ways. It could be a challenge in certain ways, with tariffs or so on. So what will the net effect be? All these components, we're now caught between these two states, if you will. We're caught between the Fed being the driver of market direction, and with interest rates and inflation, and between a new administration with ideas of greatly reducing. Not tariffs.
I mean, they want to cut regulation. They want to cut regulation.
Yeah.
They want to. The FTC is going to change. There's going to be mergers now that couldn't happen. I mean, but they want to unclog the pipes for sure.
Right. But these and that's fine. And a strong dollar is fine under those scenarios. But we're in this mushy middle. We're caught between as Scylla and Charybdis, if you will, to be. Have a mythological metaphor. There's no out here. Something needs to give way, and even after Trump is sworn in, there's no magic wand. These things don't happen instantaneously. There's going to be a period of time, and so we may be in this malaise, if you will. This range could be forming here for some period of time until there's a clear path forward that everything drops into place for us for a lot of growth and momentum behind that growth to reassert itself. Because right now the momentum had dried up in the markets a while ago.
All right, I'm going to get to earnings in a little bit because I think we want to cover that just in its own bit. I want to talk about semis. Let me touch on volatility real quick. The VIX today closed at 19.54, and that's the highest close since, if I look at my chart, back in December. People may remember in December it actually went to 27.62. Always remind people the VIX index, the one you see on TV, is not a tradable product, and it's looking at option prices. I think 19.54, yes, it's definitely elevated, but it's not. It almost didn't rise enough, and to me, I'd like to see the VIX over 20.
Yeah.
to see, that there's some real fear. The VVIX,
It's going to go higher.
you think it's going to go higher? Okay.
I do. Yeah.
All right.
The VIX is going to go higher, and so will the VXN, which is the volatility on the NDX.
Sure. The NDX vixen, the vixen. Yeah. The NDX VIX. VVIX, by the way, hit 115.49. And the VVIX is a measure, much like the VIX looks at prices on the SPX index. The VVIX looks at VIX options, which are actually options on the future. But this has been a little. I mean, look, today was on a percentage basis, and we've had a couple days, but the VIX has not exploded like it did in December.
No,
not at all.
It's grinding higher.
The VIX is grinding higher. Yeah, that's a good way of putting it. I think that's a good way of putting it.
Yeah, and it's I don't think it's done. And look, I'm not. You know me for a long time. I am not generally bearish, and
it's my fault. I gave you a bunch of topics that I said we got to cover, and some of the stuff it's easy to be bearish on it.
It is, but when you look at the breadth, again sticking with the NDX, look at kind of peeking inside the NDX a bit. If you measure things, going back to some technical measurements that are pretty basic, but they're interesting ones to look at. Percentage of stocks in the NDX that are above their 50-day moving average, which is kind of just a default average that a lot of folks look at. Only 24% of stocks are above their 50-day moving average. That's not good. That's also kind of an extreme level, and sometimes there are reversals from that level. But the number of stocks above their 150-day moving average are only 49% of stocks. And so there's some weakness developing in there. And it's plausible that we'll have a move down, to the 150 if this triangle that we talked about earlier breaks. And that level is like 488 on the QQQ.
I feel like you probably have a couple of technical analysis books on your desk. Am I right?
I do. I have quite a few of them. But the one that I talk about.
Give listeners a recommendation early. Yeah.
Well, look, if you have an interest in any of this stuff, now there's all kinds of things about this indicator or that one or whatever. I like to look at things on larger, more fundamental levels. I would recommend acquiring a knowledge of chart patterns, and the Encyclopedia of Chart Patterns by Thomas N. Bulkowski, second edition, is a great text. It's a reference book. It's filled with stats. Bulkowski, no one knows this, of course, but has done the seminal work in this arena, and all of his all the inputs are just filled with, what the break even is, what the average return is, what the failure rate is on all of these types of chart patterns. I highly recommend if you're interested in getting involved in stuff like that.
All right, we'll put a link in the show notes. That's a good one. I feel like I'm looking at my shelf here. I got tons of. I'm sure Murphy's up there. I got I got a bunch of those. All right, let me go back to the topics. One other thing I just want to mention before we maybe get back on the bullish side is very sleepily. That's not really a word. Very discreetly. Have you seen crude oil? Like, oil prices are starting to go up. And
they're creeping up.
They are, and not crazy. I mean, we're not above the October high yet, and we're certainly not anywhere near the July or the April highs of last year. But this is an input in CPI, and it has been very sanguine for a while. And if inflation's a thing, if CPI numbers are going to matter, and CPI X oil, X food, X housing, that's the super core, basically services. This thing creeping up would not be good news for the print of CPI.
No. No, it would not.
No, it's okay. That's it. We'll leave it
Yeah.
there. Yeah, no,
Yeah.
I mean, it's just something to watch. I've been watching it for a while, and this will matter when it matters. And
If you want to look at it just by the sectors,
yeah,
the technology sector represented by XLK over 6 months, as I mentioned earlier, it's down around 3.4%. XLE, which is the energy sector, is up about 0.5% over the same period, over the last 6 months.
nobody wanted energy coming into this year.
No one wanted it. No one wanted it. And I think going forward, energy and financials could do very well. And by the way, financials over the last 6 months, quietly, are up almost 14%.
Yeah, I sort of knew that, but saying that number out loud, and that was the broadening, though. I mean, here's the thing: people keep talking about the concentration in the markets, and it's very tech heavy. But then you throw out financials are up 14%. Now they're not, the weighting in the S&P isn't, and certainly in the NDX isn't as much. But that is some broadening right there.
Right.
Yeah.
But the one that bugs me the most is XLU, which is utilities, over the last 6 months is up 10.5%. That
AI
isn't, yeah.
Yeah.
10.5%.
Normally, and I know, I'm just going to say it. Normally, if interest rates are going up, that's a bond proxy that should be going down. But
Right.
it's AI. It's like, oh, we're going to need more energy.
Yep. And that's what's pulling precisely where I was going.
Yeah.
That's what's pulling it higher. Normally, AI out of the picture, you're like, oh, utilities is attracting a lot of attention. That's bad for equities. Right?
Can you imagine if you said, oh, I know rates are, imagine somebody said, I know rates are going up. I'm going to short utilities. Oops.
Yeah.
I mean,
you would have thought, okay, yeah.
Stuff.
Yeah, reasonable. And that would have worked, until it didn't, 20 times in 25, that would have worked, except you'd have got burned this time.
All right, let's talk about earnings a little bit. This to me is, we're in this lull where we ended earnings season last year. We had a gully in how much info was coming out. Sure, we've had employment. Remember, the market was not happy when employment was bad, and apparently now it's not happy when it's good. But earnings are coming. Next week in earnest, let's see who we have. So KB Home is Monday. Okay. But then we have Citi, BlackRock, Wells Fargo, JP Morgan, BNY Mellon. They're on Wednesday. Thursday, we have Goldman Sachs, Morgan Stanley, PNC, some more banks, Bank of America, United Healthcare Group, which I think that will be interesting. But TSMC, and they make all the chips. So that's going to be an interesting one. Yes,
they do. And that will affect semis, which is a sector that you and I paid a lot of attention to for a while now.
Yes,
and because looking at the AI revolution, and it is real and it is continuing, but we may be at a bit of a lull right now for the reasons that we've just mentioned. There are all kinds of ways, if you were of a mind to be involved in that, through buying various stocks or mutual funds or what have you, ETFs. But a way to look at it is wanting to own the picks and shovels of this new gold rush, this new AI gold rush, and that is semiconductors, right? And semis did really well. And for the last 6 months, they've been basically flat. For 6 months, semis have gone largely nowhere. And again, they're forming the same pattern. They're either going to break to the upside where they're coiling up and earnings will be great. Semis will break out to the upside for a new big leg up. Or we're going to have to endure some more downside before a new base can be formed and we start back up again.
I'm looking at SMH. SMH is it's different than the SOX index. So the SOX index is going to have a more equal distribution weighting.
Yeah.
But SMH is one of the more popular ETFs that have semiconductors,
Right.
and it's top heavy. I'm looking at the volatility, and I'd say it's about 35. So 35 volatility would say, basically a one standard deviation move on the SMH is right around, it's over 2% is what the option market is pricing in on a daily basis, up or down, kind of that range. And yeah, here's the question with semi, and I don't know. Look, again, if you want to buy them, you buy them. If you don't want to buy them, don't buy them. If you buy them, there's an argument, why not hedge? That's why we buy, we hedge, we do all those things. But to me, I think, the bear case on semis is they already pulled forward all their future earnings, and the growth rates can't possibly keep up. If they ever go and they have a growth rate of only, in air quotes, 20% every year or 15% every year, like NVIDIA. But I think kind of, if you want to take the bull case, this is still early in this whole AI thing.
It's very early. And so no one knows what the future holds or where, this AI phenomenon is going. I do believe that it is very, very real. People like to place this against what happened back in 2000 and 2001 with the internet boom and the ensuing tech wreck. The difference is NVIDIA is not gauging its earnings on clicks and eyeballs. It's gauging its earnings on the fact that it's producing a number of products that absolutely everybody wants. They can't build them fast enough, and they're making $1 billion a day.
Let's think about, if I just look at the Philadelphia Semiconductor Index, the SOX, as we call it, and looking at the index and the members of that index, they're saying over the next fiscal 12 months, the analyst, and analyst expectations can change, 27.84% growth in earnings estimates. Now, that's known. You could argue that's already priced in. If you have an efficient market. The 2 year, and then they say, well, let me put some numbers on this. The actual was 155.35 per share on the index. Next year, 198.60, and I'm getting this off of Bloomberg. And then 2 years, the forward 24-month estimate, 261, and that would be 31.5% growth year over year. And then it kind of slows down year plus, so 36 months forward is 11% growth. But, the forward estimate is like 26 forward P right now. The overall market is 22.5. So, and the analysts are telling us that their expectation is for that type of growth, which is, that seems bullish. I don't know. I don't know if it's already priced in. You never know.
That is solid. I would go so far as to say robust growth. But what you're about to say is correct. We don't know how much of that is priced in today.
Let me ask you a question on AI, and I'll throw a curveball at you. One of my favorite books, Technical Revolutions in Financial Capital by Carlotta Perez, looks at these major turning points. And the Industrial Revolution, the second one's Age of Steam and Railways. Third, Age of Steel, Electricity, and Heavy Engineering. Fourth, Oil, the Automobile, and Mass Production. By the way, that started in 1908. And the fifth one was the Age of Information and Telecommunications, starting in 1971 with the Intel microprocessor. Is this a subset of that fifth one, or is this like the sixth one? The sixth one.
This has to be wave 6.
You think so? Okay.
Yeah.
Oh, interesting.
Yeah, because it's going to see the rise. AI will change things in ways we can't imagine, for better or ill. We just don't know yet. But it is going to be impactful, but it's not going to reach its full potential, if you will, without the development of quantum computing.
No, that's right.
And quantum computing stocks and there are a few of them out there historically have not done well. They've languished and been sort of just curiosities. A lot of them have taken off to an extent given what's going on, but they're making real progress with it. And at some point, because that's a whole new thing. I'm not even going to go down that rabbit hole right now, but quantum computing is an absolute sea change from how things work right now.
I don't know when the inception of this, the QTUM, which is a quantum computing, and I'm not familiar with, well, I mean, some of these companies I am. But so let's see. The last 6 months, as of the end of the year, it was up basically 30% over 6 months. Over 3 months, it was up 30%. Over 1 month, it was up 50.5%. And I guess it did 50% last year. I don't know what the inception date was. I don't think it probably incepted in. I
don't think it's more than 5 years old. Is it?
No, in fact, maybe January 9th of last year. I think it's 1 year old.
Okay. Anyway,
I mean, I think the secret's out about some of these. Like if you buy this, you're not early. I mean, I don't know what these stocks are going to do. I don't know what, I haven't looked at this, but
yeah, no one knows. But
I mean, your point is that there's different technologies that still have to happen to move this forward, and it really drives to the productivity story. Like if we have a major increase in productivity, that gets really interesting for markets.
Right, and again, all manner of things drive productivity, innovation, new technologies, and certainly AI can drive productivity. And we're not in a position right now to measure that, but we know that down the road, these things are going to occur. They're going to continue to occur, and they're going to be, one would like to believe, the net effect of them are going to be positive.
On these stocks, I mean, just thinking about the semiconductor index, I mentioned it's like 25.99 forward PE. Here's the other thing, and we'll bring this back to the overall markets. The multiple is not cheap, both in the overall market and in fact, we're looking at semiconductors. Is it cheap relative to where it's been? I'm more familiar with the S&P's multiple. But you could have earnings go up and the multiple go down. What we've seen prior to the start of the year is, I mean, for a good 9 months, we've had the multiple go up and earnings expectations go up, the forward earnings. So, that's I guess the question. If we want to think about the S&P in total, Spencer, I mean, when I took this, we're trading about 22 and a half times forward earnings, just to kind of set the audience, what the S&P is as far as a growth rate. The expectation is 10.23% growth in earnings over the next year, which would be good. The forward 24 month is 13.85, and then the forward 36, like you skip 2 years, and then what will be the next 12 months, 9.5. I mean, analyst expectations so far, even though the market's off, the expectations are still pretty strong. I guess, maybe it's a multiple contraction that we're seeing, and it could have to do with rates, right? But I mean,
it could be, and I think a lot of this is affected by rates. It is affected by the 10-year yield, and those things are going to resolve, and however they resolve, rates are going to come down. The Fed is not going to leave rates where they are. They're not going to come down right away or on any time frame, I think, that's going to make the market happy. But the Fed is more concerned about inflation than it is making the market happy. As well, they should be, because their mandate does not involve what the market does or does not do.
I'm looking, by the way, at just, I'm always interested in how the options market is pricing in a stock around earnings. So TSMC, Taiwan Semi, they are coming out next Thursday. I'm just looking at the option chain. Stock closed today, 208.37. All right. There's not a 208, strike, but the 207 strike if you said, okay, I don't know where it's going, but I want to buy the straddle, and there's issues with that anyway, with you could be right, you could be wrong.
Mm-hmm.
I'm just looking here. So, $6.20 for the put. And what do we got here for the, is that $7? Is that really $7? Oh no, $6. Yeah. 620 and 740. So what's that? 13, call it 13 and a half bucks.
Mm-hmm.
So that's the price of the straddle. The volatility that I'm seeing there is, it's got like a 56% implied volatility. So what that's saying is 56 divided by 15.875. Yeah, it's a 3.5% 1 day standard deviation move priced in right now. So with earnings coming up, the volatility is higher on that, but the straddle cost is about 13 and a half bucks. So if you buy the straddle and it doesn't move that much, you need to move, what's the break even there? 13.5 divided by 207.5. Yeah. If you bought that today and it doesn't move more than 6.5%, you lose money because you have the time premium. But all right, we'll see what happens there.
I'm just looking at this SMH chart.
Yeah.
We're consolidating right now. We have been for quite a while. And that really is because from the lows, when you and I first started talking about semis, we're going, semis have to start moving higher. It was back in 2022. And the SMH was around $100 a share.
Yeah, sure.
So it's up 146%. Right, from where it was. At one point, it was up nearly, what was the high on the SMH? 260 some odd?
283,
283?
I think. Yeah, 283.07. Okay.
So it was up dramatically. And what after a move like that, and a lot of this move, there weren't a lot of rest periods. There weren't, periods of consolidation. It was... particularly in 23 and earlier on this year, they were straight up moves. It's a massive move, man. And just on a chartist point of view, it needs to rest, as we like to say. It's resting right now. And
did you see the Head and Shoulders? It never became anything. I don't know.
I did. And we talked about that a while back, and it did not. It did nothing.
Yeah, it spit out the right side, and it's been oscillating in a small range.
Yeah, so that invalidated, by the way, that pattern was invalidated. So
Head and Shoulders, for the audience, is if you look at a chart and it looks like a left shoulder, a head, and a right shoulder, and then you draw a line underneath, that's the neckline. If it breaks a lot of times the probability is it goes the distance between the head to the neckline down. But you talked about resting for a little bit.
Topping pattern. Mm-hmm.
Like, to me, the market pulling back, it's totally natural. It happens all the time. Even in strong years when the market's up towards the end of the year, it's still up. Like, to me, this is healthy that the market is resting and earnings can catch up. The multiples can catch up.
Absolutely. I'm not wringing my hands or anything. I'm just waiting for things to get back on track. I think long run, look, there are always three trends in place, right? The long-term trend, the intermediate-term trend, and the short-term trend.
Yes.
The short-term trend is down right now. The intermediate-term trend is sideways, and the long-term trend is up still. Now, that could change, but that's where we are right now. And markets have moved dramatically from the 2022 lows. And again, not without very many or lengthy consolidation or / rest periods. Now we're seeing some lengthy consolidation come in. And that's appropriate. And I think in the short term, markets are are going to be headed a little lower from here, most likely. I mean, what do I know? But that's just what everything that I usually follow and look at are telling me, personally. But does that mean that we're doomed and we're looking at another 2008 or 2022 scenario? No. We've come a long way. We're resting right now, but you do that so that you can gather up enough energy to take the next leg higher. And I think that's where we are. We're waiting. We're stuck in the soft middle, just waiting for for the starter pistol to be fired off again, and then markets will continue higher.
Well, we're going to get a look over the next couple of weeks. It's all going to happen. I mean, it's all going to be. When I say happen, you get the earnings, you get the forward guidance, you get the conference calls, and the market is finally going to have some, some inputs and data that it can make the decision where it wants to go. I mean, I always go back to 95, 96. And for those of you who have been listening, I keep going back to that period because that is a time when interest rates went up after the Fed lowered 3 times. The 10-year went up 100 basis points. Now, we went up 100 basis points in like a month or 3 month, and we continued. But earnings or interest rates being higher or going higher aren't necessarily bad. I think you and I agree. It's the path there. It's getting from here to there that's a little more painful. And it all comes down to earnings. But this is why, I mean, everyone in the audience knows, and you can send me an email, derek.moore@zegainvestments.com. That's derek.moore @Z as in zebra, E as in Andy, G as in George, A as in Apple. You got to spell investments correctly on your own, .com.
Yeah.
But, I mean, it's just, this stuff is, there's a couple things that need to resolve here. I'm fascinated that you think AI is the sixth major technological revolution. And
I do.
Yeah, that's. Did you see Jensen on?
I did. I watched the entire thing.
What is that called?
Was it CES?
Yeah.
Yeah. And he was amazing. And
Jensen, by the way, is the CEO of NVIDIA. But continue on, Spencer.
And I was also amazed by his jacket, which was.
What did he wear this time?
It was shark skin.
Okay. Not the members only one?
No, it was in Las Vegas. He was wearing a leather shark skin jacket, I guess, because he thought he needed like a Vegas show or something. But when he just outlines the things that NVIDIA is doing and the things that are fueling all of this, you think, well, surely for a challenger will eventually emerge, or a number of challengers. I mean, who knows? But NVIDIA is so dominant and so far ahead in all of these categories because no one else was really doing it at the scale they were doing it. It's just astounding. It's astounding because I can remember back in 1999 or 2000 when NVIDIA was about $6 a share and it was in danger of going bankrupt after the tech wreck. And they didn't, obviously. And no one would have forecast they would be where they are right now. They started this investment in AI several years ago, and a lot of people thought, what are you talking about? AI? What do you mean? And so they started working on this long before other people, and they're reaping the benefits of it today. Their new unit, I think it's called Blackwell, that everyone is trying to get their hands on, as Jensen said, and I couldn't believe this, but he said it, so I guess it's true. It's being produced at 45 factories around the world, 24/7. Wow. And that's not enough to keep up with demand.
Wow, that's something.
Yeah.
That's amazing. I guess, for me, AI, do you remember when the iPhone first came out? Did you have it, the first iPhone?
I didn't. I'll tell you why, because, it came out and people went, some Apple gadget.
Well, this is where I'm going with this.
I had
So,
a BlackBerry.
oh well, yeah, me too. Of course,
Yeah,
I missed the keyboard, but the
yeah,
reason why I'm bringing up the first iPhone is if you remember, people I knew who had it. They would pull up an app and they would, swing their phone around. And it would make the sound of a lightsaber like
yeah,
that, and you'd say, "Well, what's the purpose of this?" I mean, you could argue that we haven't, like right now, just asking ChatGPT to do a calculation is it lightsaber sounds? I don't
yeah.
know, but
That's
it's maybe.
that's where we are. My perfect analogy, by the way. That's where we are right now. The stuff that's happening right now is child's play.
Hmm.
The things that are going to happen later on, we can't even. I mean, look, I'm barely smart enough to do what I'm doing right now, and I can't even begin to imagine what's going to happen down the road with AI. But it's going to be staggering, staggering. It's going to change everything. Think how the internet changed everything. Think how the iPhone changed and all these devices changed how we interact and the things that we do and how information is transferred. That, I think, and I really believe this, is going to seem small compared to what AI is going to do.
It's going to be interesting. All right, Spencer, we have to. I take something from who Barry Ritholtz is, right?
Oh, yeah.
Yeah. So Barry has a show called Masters in Business on Bloomberg, and at the end of it, he always asks his guest, "What does he say? What are you watching, reading?" He asks for recommendations. So that's if anyone ever wants to know where I got the idea of bringing up recommendations, Barry Ritholtz. And Barry actually, my literary agent, I believe, was his editor on one of his books.
Oh, nice.
I believe that. So you gave us the technical analysis book.
Mm-hmm.
Anything that you've been checking out? Could be a movie, could be a book, anything.
Well, this is really going to light people on fire. I have been reading in my spare time. I like to take college courses online.
Okay. Same. Talk about that.
And right now, I just finished a course on great leaders of history. Right now, I'm taking one on Plato. It's about to be done with, and I'm in the middle of one on the rise and fall of the Soviet Union. And being I'm 55, and I grew up through that era, and that's what I studied in school. So I just find it interesting, and I just like learning and things like that, and the things you can do now, as to say technology, that are accessible. They're not expensive by a lot of measures, and to get access to some of the greatest lecturers and everything, it's just amazing. And I do this. I take college courses for fun. That's what I do.
As you know, I teach some graduate economics and finance courses. I say on the side, I take it seriously, but it's not obviously the main thing I do. And at some point, I just, like Professor Aswath Damodaran, he's way better than I am at teaching. And at some point, it's just like, maybe we'll just have the best people teach the classes. And I don't mean to, not have me, I don't want to work myself out of a part-time job, but I mean, I think it's all possible. And you can go and if you want to learn about probabilities and stats, you can take a Harvard online course now.
Oh, sure.
It's there.
Oh, yeah. You can get the degrees online now. I don't know if they're any cheaper. Maybe some, but I take stuff that's not for credit. You just pay to do it, and it's not expensive.
Interesting. All right. I'll have to find out more about that. So I watched a documentary. I'm not actually through it, but Don't Die. It's about a guy, he's 47. And I don't know if you've seen this rise of these, longevity gurus like Peter Attia and other people.
Yeah.
Is it Huberman or yeah.
Mm-hmm.
So this is a guy who's a tech entrepreneur, and he's got millions of dollars. And he is basically doing a protocol to reverse his aging. And so I was watching that on Netflix, and it's pretty interesting. I haven't finished it, but I mean, it's sort of, I mean, he eats certain things, he exercises, he's doing all these like light treatments, all this sleep stuff. It's kind of like if you've read Peter Attia's book, Longevity, it's almost like he's doing a similar thing. So I was watching that. It wasn't bad.
Well, I'll have to tune in.
Yeah, there you go. All right, Spencer, we did it. Thanks for stepping in and being a guest co-host. So Tony Randall, I joked around about that. So he was on the show The Odd Couple, which he was also in many movies. But David Letterman's studio, and I used to live in New York and northern New Jersey. David Letterman's studio, once he was at CBS, was on, what was it, 57th and like 10th Avenue, I think, or 9th Avenue. It was the old Ed Sullivan Theater. And when David Letterman had either a cancellation or there was bad weather, Tony Randall would show up. And he was probably a guest tons of times. And he was hilarious. So,
oh, man.
So most of the audience is like, who the hell is Tony Randall?
Who's Tony Randall? And he also had kids into his 70s, by the way.
He did.
Yeah.
He did. He was a spokesman for, what was the pretzel company that Anheuser-Busch owned? Eagle Snacks?
Yep.
Yeah. Okay. So there you go. Well, anyway, thanks, Spencer, for stepping in. And we'll be back next week. We may have another guest host next week. And then plan is Jay may be back in February. So, all right, everyone. Thanks for listening. Make sure and if you give us I don't know, you can rate us 5 stars or review it. Only 5 stars, though. If it's less than 5 stars, don't bother. We don't want those. So, see everyone. Have a good week.
Bye-bye.